From Impact Alpha, it's This Week in Impact, where we bring you some of the most interesting impact investing and sustainable finance stories of the week. It's Friday, March 14th. I'm Brian Walsh, and this week I'm joined by Impact Alpha editor David Bank. We'll discuss the significance of noted green banker Mark Carney's new role as Canadian Prime Minister. Plus, what's at stake as U.S. climate policy heads to the courts. And finally, why one impact fund manager says low-income customers are more profitable, and they have the data to prove it. That's all coming up on This Week in Impact. Hi, David. You've been on the road for a few weeks. Welcome back to the podcast.
Hey, thanks, Brian. It's great to be back, and there's certainly a lot to talk about.
Yeah, well, let's jump right into our first topic. Don't blame Canada. Notable Green banker Mark Carney is expected to succeed Justin Trudeau as the 24th Prime Minister of Canada today, March 14th. Now, David, this comes amidst President Trump's continued trade war with some of the United States' closest allies, particularly Canada. Those in the sustainable finance space might be familiar with Carney's role as a green banker. You and Amy Cortese wrote about Carney this week. Tell us more about his background.
Yeah, well, we've been watching Mark Carney since he was the head of the Bank of England. He had previously actually been also the head of the Bank of Canada, but as the head of the Bank of England, he was kind of leading the charge for central bankers to, green the banking system, as they say, and had a famous speech, I think back in 2015, talking about the tragedy of the horizon, which was, the time horizon under which most investments are made didn't actually allow anybody to take into account climate risks, which he said kind of posed as existential, if not more of a risk, as the mortgage crisis of the great financial crisis, and that essentially that since most of the fossil fuels had to be left in the ground in order not to exceed the carbon budget and blow past the 2-degree threshold and all that the assets that were on the books of the oil companies would become stranded assets. And that was a bubble that was going to burst. And, so the guy knows what he's talking about in terms of, climate risk and climate accounting. He effectively, caused to happen the task force on climate related financial disclosures, which has become something of, sort of became the bedrock of most climate disclosure, regulation. And so, people are thinking about his, taking on Trump in the trade wars, but we have a guy in there, at one of the major, G7 or is it G8 now countries, as a real climate champion.
Yeah. So what is the significance of him stepping in to lead at this moment? I mean, just building on that, I mean, he has this great climate background and he understands the issues and the risks around climate and how it impacts the financial system. And what does that mean for investors, and what does that mean for citizens in North America?
Well, we'll see. I mean, he's got to stand for an election at some point in a snap election. And Canada is a big oil producing country with major oil companies that we may have something to say about whether their assets are stranded or not. So that's going to be an interesting domestic political fight in Canada. The other thing to note about him, and people will maybe know, is that he left the Bank of England to join Brookfield, which is one of the major kind of private equity and infrastructure investors, and was a prodigious fundraiser for what they're calling their global transition funds. And the first one was, I think, $15 billion, and I think they've gotten to at least a first close on the second one, another $10 billion. So he's raised like $25 billion in 2 global transition funds that are effectively betting on corporations and others having to decarbonize all of their operations and all infrastructure, and it's quite an ambitious raise. Now, obviously, people in those positions love to raise money, but it's because they think they can put it to work. And he says basically that corporate demand for decarbonization technologies is a big driver of all kind of private equity and infrastructure going forward. So there's a lot of money at stake, as well as obviously the politics.
Yeah, there's money at stake, and Carney was at the helm of the Bank of England, as you noted, and also as the UN Special Envoy for Climate Action, in which he co-chaired the Glasgow Financial Alliance for Net Zero, or GFANZ, which had a number of big institutional investors and big banks make commitments to it. But that is kind of unraveling in recent years.
Yeah, yeah. I mean, exactly. So it's all kind of hangs in the balance, as you say. Like the G fans, and then there were subsidiary groups, for asset managers and for insurance companies and whatnot. And it's essentially come unwound. They're going back to think about what their strategy is because all those big financial institutions pulled back under threat, frankly, of legal sanctions and investigations. And the House Judiciary Committee in particular sent subpoenas to all of them, claiming that they were part of a climate cartel that was, illegally, I guess, driving up consumer prices by committing together to these decarbonization or net zero goals. And so there was a real kind of legal reign of terror, which hasn't really ended against these kinds of climate associations. Now, you could say that the primary drivers of those moves should continue, whether or not the formal associations do, because it's in companies' interests to decarbonize their supply chains, but without kind of both the kind of peer pressure and then even now, the pullback on climate risk disclosure kind of things. You could also think that some of the impetus for those changes is going to go away. So that's exactly what's hanging in the balance: whether climate action has kind of enough momentum to withstand, the distractions, shall we say, if not, outright pushback that's going on in the U.S.
All right. Well, you can read more about Amy and David's article on Mark Carney on ImpactAlpha.com. There's also a link in our show notes. But for now, let's take a quick break. And when we come back, speaking of climate disruptions, we'll discuss how U.S. climate policy is headed to the courts. President Trump's Environmental Protection Agency has taken a hatchet to the Greenhouse Gas Reduction Fund, a so-called green bank established as part of former President Biden's historic climate change legislation known as the Inflation Reduction Act. EPA Administrator Lee Zeldin has officially terminated some $20 billion in green lending funds, triggering a wave of lawsuits and other legal actions. Now, David, you, Amy Cortese, and our producer extraordinaire, Isaac Silk, covered the action for us this week. What's at stake, and what is the current state of play?
Yeah, well, we've been watching the Greenhouse Gas Reduction Fund. It's part of the Inflation Reduction Act, but it was a very ambitious effort to set up a whole nationwide, essentially green lending infrastructure that would reach down, particularly into low-income communities that were undercapitalized, and bring the benefits of green energy and electric vehicles and mobility and clean air and green jobs into every community. And we got quite excited about it, honestly, over the course of the last year. And it is now directly in the crosshairs of the Trump administration, and particularly Lee Zeldin, the head of the Environmental Protection Agency. And they've gone after and tried to rescind and reclaim this $20 billion that had been already awarded and contracted and actually distributed out to three coalitions of groups. So you mentioned the Climate United, and there's also the Coalition for Green Capital, and there's something called Power Forward Communities. And all told, there's, I think, about 20 different subsidiary organizations in them. And they were making green loans and doing deals and helping electrify school buses in one case, and helping set up solar mini grids on campuses of the University of Arkansas. And it was all moving forward, and now it's all been frozen for the moment, and as you say, is now subject of a number of court battles.
And one of them is around the $20 billion that is sitting at Citibank, which is essentially just the steward for these funds. So what's at stake there?
Well, yeah, it's super interesting because, frankly, in anticipation of what might happen, the way that this program was set up was that the 20 billion of the 27, so that's a nuance, but the 20 billion was deposited at Citibank, which was a financial agent, and then could be drawn down by the entities, the approved entities that had gone through an RFP and all kinds of reviews and were contracted, could be drawn down, as they made these loans. And the one reason for it was that being able to service these kinds of loans required a financial institution that could move more quickly than the federal government just in getting the money out. But frankly, I think part of it was to safeguard it against what has in fact happened, which is policy reversals at the administration level, and to have it already be out the door and sitting at Citibank is different than having it sitting at the EPA or at the U.S. Treasury. And so it was a little bit of Trump-proofing that program, and now that that strategy is being put to the test. And Citibank is in the middle because Citibank has custodial responsibilities, for the money, and has to obey the law and not, mess up its customers' accounts. Otherwise, it might suffer some reputational loss, among its other customers if it can't really protect their money. And that's kind of the first thing that a bank is supposed to do. On the other hand, it can't really go up against the administration directly, and so I think they might be, secretly happy that it's in court and a judge might sort it out as soon as next week.
So what's happening next week?
Well, the court case, Climate United sued first, and then the other two, the Coalition for Green Capital and Powered Forward Communities, also sued this week. And the court case got put off from this week to Monday, when Judge Chutkin is going to ask both sides for more evidence about whether there's really any basis for suspending the access to the account and terminating the contracts for that matter. So the EPA is going to have to put up some proof, and it's going to have to pass a judge's muster. And as best we can tell, they have yet to put up any such evidence, and whether they can come up with something that passes a judge's criteria, we'll see. And it's possible that the money could be ordered to start flowing again, and that would undoubtedly be appealed. So there's many more chapters to come. But in this case, if possession is 9/10 of the law, at least the green lending groups have a bit of a leg to stand on.
All right. Well, we'll be continuing to watch this story as it unfolds very closely. You can read more of our coverage on the legal action surrounding climate policy on ImpactAlpha.com. There's also a link in the show notes. For now, let's take one more quick break. When we come back, we'll talk about why one impact fund manager says low-income customers are more profitable, and they have the data to show it. Elevar Equity is an impact investment firm that focuses on underserved communities. ImpactAlpha's Shafali Anand had a story this week about how Elevar has demonstrated that investing in low-income customers can yield higher profitability. David, tell us more about how Elevar reached this conclusion.
Well, Elevar has been on the case of emerging consumers. As you say, they now call them entrepreneurial households. At some level, it used to be called something like base of the pyramid or low income. Those have kind of down market kind of connotation. So entrepreneurial households means the kinds of families that are very common in India and many other places, where many people live together. Incomes are pooled, expenses are pooled, and the whole family operates as a sort of economic unit. And that's a growth market in India, Elevar said, and they've been arguing that for many years. And now what they've done is put together an index, the Entrepreneurial Household Index. So if you're investing, in the Indian stock market, you can invest against this index, and they say you'd have done better than folks might know the Nifty 50 in the Indian stock market. This index outperformed the Nifty 50 by something like 16.4% to 13.6% since 2017. So companies that serve this growing entrepreneurial household market did better than the market as a whole.
All right, so can you give some examples of types of companies that are serving these so-called entrepreneurial households?
Well, in the index itself, there's microfinance firms, there's a gold jewelry business, there's a small finance bank. So they categorize them in different ways of folks that are kind of targeting this market. But the example that we had in the story was a smaller company called Sarvagram, and it provides loans and financial services to rural households. But instead of just taking the individual borrower into account, it takes the the whole family. And so they say, for example, if a family member can afford a mobile phone, they can also afford to repay an education or a housing loan. And so again, it's in this category of kind of alternative credit scoring or different ways of underwriting risk and loans that's coming. In many there's lots of examples of that. But Sarvagram just raised $67 million in equity, and not only from Elevar but Temasek and something called Peak 15 Partners, and there's big money to be made in that customer segment.
So I take it the goal of this index is to show that you can do well by doing good, right? That by focusing on low income customers, you can get higher profitability. But doesn't that invite the criticism that if you are reaching higher profitability off of the lowest income consumers, that you're in some ways exploiting them?
No, I don't think so. I mean, I think it's always been low margin, high volume is the idea that you're reaching so many more consumers with very needed goods and services, and if you give them good quality and good prices, you can serve them well and also make a profit. So I don't think there's any kind of incompatibility between those two goals. If anything, it goes the other way. Most companies, I think, assume that they should go up market to more affluent consumers and be able to get higher price points by serving a more elite audience. And I think what Elevar and others have been arguing for many years is no, go down market, do it on a kind of mass market basis. As long as your unit economics are positive, you now have a vastly bigger market. And if you're, if you're providing good quality goods and services that folks need, you're going to do pretty well. Elevar has a basic thesis, which is basically if you can save your customers money or make them more money by helping them become more productive themselves, then your business will be successful. So it's there's mutual benefits there.
So it's not just generating social impact, but also offering attractive financial returns.
Absolutely, and that's what scales up, and that's what improves the lot of both those consumers, and then obviously workers and communities as well.
All right. So what's next for this Entrepreneurial Households India Index?
Well, Epic World, which is kind of a sister organization of Elevar, wants to see 50 companies serving these entrepreneurial households grow up into real blue chip companies over the next 20 years. The companies, the 34 companies in the index now have a combined market cap of $115 billion, but they've been growing by 22% a year over the past 5 years, and that's versus 12% for the Nifty 50. So, entrepreneurial households are maybe small, but coming up strong.
All right, so there is indeed a fortune at the bottom of the pyramid?
Yeah, to coin a phrase. Thank you, Brian.
All right, well, you can read more about Elevar Equity's Entrepreneurial Households India Index on ImpactAlpha.com. We'll also have a link in our show notes. But for now, that's going to do it for this episode of This Week in Impact. Thank you, David.
Thanks, Brian, as always.
And thank you all for listening. This Week in Impact is a production of Impact Alpha and part of the Impact Alpha podcast network. Smart conversations by and for impact investing professionals. For exclusive stories and insights about the world of impact investing and sustainable finance, join thousands of other agents of impact by subscribing. Just go to impactalpha.com/subscribe for full access. Thanks as always to our producer extraordinaire, Isaac Silk. For David Bank, I'm Brian Walsh. We'll see you next week for more Impact.